All right, let's get right into it. There's this one concept that honestly is the big dividing line between amateur traders and the pros. It's called the risk to reward ratio. And I'm telling you, once you really get this, it's going to completely change how you look at profitability. So let's break it all down.
So, let me just throw a question out there for you. Is it possible for a trading strategy that wins 70% of the time to actually make you go broke? I mean, think about that. A 70% win rate. That's the dream, right? But the answer, and this might shock you, is a big fat yes.
Okay, look at this. This is that exact paradox in action. You've got System A wins only 40% of the time, but it's making money. Then you've got System B winning a massive 70% of the time, but it's a loser. It's bleeding cash. How on earth is that possible? Well, don't worry. We're about to dig into the math and solve this whole puzzle.
Yeah, this all comes down to what I call the high win rate myth. It's this belief that so many people have that just winning a lot is the name of the game, but it's not. It's really not about how often you win. The real secret is how much you win when you're right compared to how much you lose when you're wrong. So let's unpack that a bit.
And the key, the real secret sauce here, is this concept, the risk to reward ratio. You'll see it as RR a lot. All it is really is a simple measurement. It just compares how much money you could potentially make on a trade versus how much you're willing to lose. Think of it as the foundation of smart trading. And you know what? The math behind it is super simple. Seriously. First, you figure out your potential profit, right? That's your take profit level. Then you figure out your potential risk. That's your stop loss, where you say, okay, I'm out. Then you just divide the potential profit by the potential risk. Boom, that's your ratio.
So here's a great example of a really favorable setup. We're talking a 3-to-1 risk to reward. What that means is for every single dollar you put on the line, you're aiming to make $3 back. Your potential reward is just huge compared to the risk. This right here is what the pros are constantly hunting for. Then you've got what's called a neutral or a 1-to-1 ratio. Pretty straightforward. Your potential profit is exactly the same as your potential loss. Now, to make money here, you have to be right more than half the time. Your win rate has to be over 50%. And let me tell you, that's a tough game to play long term.
And finally, we have the danger zone, the setup you really want to avoid, an unfavorable ratio like 0.5 to 1. Here, you're literally risking $2 just to make 1. Think about that. Just a couple of losses here can completely wipe out a whole bunch of your wins. It's a recipe for disaster.
Okay, so here's the really important part. This whole risk to reward thing, it doesn't live on an island. Its real power, the magic, it comes out when you combine it with your win rate. This is where we get to the formula that actually predicts long-term success.
Because it's so easy to get caught up in just winning the next trade. But the real key, the thing that truly matters for long-term success, isn't just about being right.
It's about something called expectancy. This is the number. This is what tells you, on average, exactly what you can expect to make or lose on every single trade you take over the long run.
And here it is, the formula that basically decides your fate as a trader. You just take your win percentage and multiply it by your average winning trade. Then you subtract your loss percentage multiplied by your average losing trade. That's it. If the number you get is positive, congratulations, you have a profitable system. If it's negative, well, you're on a sinking ship. It's really that black and white.
Okay, remember that puzzle from the beginning? Let's solve it right now. Look at System A. Even though it only wins 40% of the time, its average win is so much bigger than its average loss that it has a positive expectancy of $20 per trade. Now look at System B. Yeah, it wins a lot, 70% of the time, but its losses are so massive they just destroy all those wins, giving it a negative expectancy of $20. It is mathematically built to fail.
I mean, this just shows you how powerful this is. With a good 3-to-1 risk-to-reward ratio, you only need to be right more than 25% of the time to be profitable. You can be wrong almost 3 out of 4 times and still make money. All that pressure to be perfect, it just melts away. But on the flip side, with a bad ratio, you have to be right constantly, almost 70% of the time just to keep your head above water.
So, the big question is, what's the perfect ratio? Well, the honest answer is, there isn't one. There's no single magic number. The right ratio for you is going to depend completely on your trading style and your strategy. So let's quickly look at a few common examples.
Take a day trader, for instance. They're in and out of the market fast. They might be fine with a 1-to-1 ratio because they're focused on winning a high percentage of lots of small trades. Then you have a swing trader who's holding for a few days or weeks. They're looking for bigger moves, so they're probably hunting for a 2-to-1 or maybe a 3-to-1 ratio. And a long-term investor, they're playing a totally different game. searching for those massive trend-following home runs. We're talking 5 to 1, 10 to 1, or even higher.
All right, so how do we take all this theory and actually start thinking like a pro? It really boils down to a massive mindset shift. You have to stop obsessing about winning or losing the next trade and start focusing on playing the probabilities over the long haul, over hundreds of trades.
So what can you do, like right now? Well, here are a few practical tips. Number 1, always know your exit points before you get in. Set your profit target and your stop loss, and don't you dare enter a trade without them. Second, you have to be disciplined. You made a plan, now stick to it. Avoid those emotional, in-the-moment decisions. And maybe most importantly, always use proper position sizing. You have to make sure that no single loss can ever blow up your account.
You know, when you really get this, when you have a disciplined focus on your risk to reward, it does something incredible. It completely transforms trading from what feels like a speculative gamble into a calculated, probabilistic business. You're no longer just a gambler guessing what's next, you're a risk manager playing the odds.
So I'm going to leave you with one final question to really think about. Take a look at your own trading, your own investing. Are you just focused on winning, on getting that little dopamine hit of being right? Or are you focused on the real goal, making sure that when you win a whole lot bigger than when you lose? Because honestly, the answer to that question will make all the difference in the world.